And so the crypto industry has solved this problem. They're like, here's a fast way to create an equity-like token, and you can trade it 24/7, 365.
Hey guys, and welcome back to the Daily Crypto. Today, we have Michael Saylor as he speaks on the future of Bitcoin and its global adoption in the crypto market. The American entrepreneur also spoke on how the coin's adoption affects its price on a grand scale. With the crypto markets crashing, many wonder, what happens to Michael Saylor's large, partially leveraged Bitcoin bet? Saylor's software firm Microstrategy invested $4 billion in Bitcoin, which is now worth less than $3 billion. As a result, investors are now concerned that MicroStrategy may face a margin call and be forced to sell its Bitcoin assets. Don't forget to comment down below what you think. Hit the like and subscribe button if you enjoy the content we do here on this channel. With no further ado, let's get right through the video.
That if you're going to arrive early to a revolutionary technology that's and the first digital commodity that's monetized in the history of the world, you're going to be in for a bumpy ride. So Bitcoin has been a continually bumpy ride for the past, many years. I think even since we got in the market, it's gone through nearly 3 cycles. And the only rational way to approach this is dollar cost averaging. So MicroStrategy is in essence just dollar cost averaging into Bitcoin. Our strategy is we acquire Bitcoin, we hold Bitcoin, and we just happen to believe that 100 years from now, Bitcoin is like Manhattan, and you're just going to want to hold as many blocks of Bitcoin as you can. If you acquired Manhattan in 1907 and 1913 and 1917 and 1921 and 1928, 1932 and 1947, and then another thing in 1953 and 57, and you asked someone, what was the right time to buy, and do you regret having bought, the top? I can't even remember which of those years were going to be the most efficient times to buy.
According to the tracker CoinMarketCap, the total market value of crypto assets has risen from about $3 trillion in November 2021 to around $900 billion as of June 29. Cryptocurrencies that were the season's flavor until around a year ago have witnessed a steep decline in every exchange metric, trading volumes, value, and profitability, as crypto winter sets in following a significant drop in prices in recent months. Because of the abrupt shift in market attitude from euphoria to anxiety, exchanges have resorted to combining short and long-term strategies to manage working capital. According to industry watchers, the exchange's revenue and margins have dropped dramatically, by as much as 80% and 60% respectively, compared to a few months ago. Let's listen to Michael Saylor as he ascertains that Bitcoin is the least risky strategy.
Generally, the view is that once you find a good thing, you just want to consistently acquire more as cash flows allow you. So our strategy is simple, right? We acquire Bitcoin, we hold Bitcoin, we don't sell Bitcoin, right? The only mistake you can make is acquire it with so much leverage that you get force liquidated on a drawdown. And that's a mistake. You don't want to get stopped out. And then the other mistake is to stop acquiring, right? And in this particular case, if I look at all the options, there's no better option. Bitcoin is the least risky strategy that we can find. If we're acquiring real estate in Africa or Asia or South America, what could go wrong there? If we bought stocks, there are plenty of stocks that are down 80%. And if you bought something that, that's on the wrong side of some government policy, then that can work against you. And, if we just kept buying gold, it's just going nowhere one way or the other. So I think that what you're seeing is MicroStrategy just dollar cost averaging as a public company. And you'll continue to see us do it because we generate cash flows and we're profitable. And this is by far the most rational thing we can do.
The halving event is one of the most significant on the Bitcoin blockchain. It causes cryptocurrency price inflation by limiting the amount of Bitcoin in circulation and raising demand for Bitcoin. The halving of Bitcoin has repercussions for all stakeholders in the Bitcoin system. The block reward provided to Bitcoin miners for processing transaction is cut in half every 210,000 blocks mined, or about every 4 years. This is known as halving because it reduces the rate at which new Bitcoins are issued into circulation by half. This is Bitcoin's method of imposing artificial price inflation until all Bitcoins are freed. The incentive system will be in place until roughly the year 2140, when the projected maximum of 21 million people is achieved. Speaking on the 4-year cycle theories, Saylor says that the price of Bitcoin depends on its adoption, technology, and utility, and additionally, it is a function of inflation.
I think there's the demand side and there's the supply side. So if I was building a model, it would be a multi-dimensional, multivariate, nonlinear dynamic model. It wouldn't be a single variable linear model. It wouldn't even be a single variable dynamic model. So I think it's indisputable that the halvings have an impact. That is, when you cut the block rewards in half every 4 years, that has a positive impact on the price because that cuts the supply that's being sold in the open market by the miners or the supply that's out there. So I think that's one element. But my model for the price of Bitcoin is it's a function of adoption and it's a function of technology utility and it's a function of inflation, all three of those. And then it's presumably a function of time, especially in the sense that over time, the supply hardens, right? And Bitcoin mining supply decreases because of the halvings. So all of those are important variables.
According to recent research, around 27 million Americans possess cryptocurrency, with Bitcoin accounting for 44.5% of the total. The number of Americans who possess cryptocurrency has not yet surpassed 10% of the overall population, although it has been steadily increasing since Bitcoin's birth in 2009. The adoption of Bitcoin is similar to that of any other technology. The adoption rate increases steadily until around 8 to 10%, then typically surges upwards to widespread adoption.
When the technology improves, like when we're building Bitcoin into a Cash App, if you build if you build Bitcoin into Cash App and then you build Lightning into Cash App, and if I can send you $5 of Bitcoin for free in a split second, then the utility of Bitcoin is much higher. And as Lightning rolls out to all of these application protocols, you know, as companies like Kraken, when the exchanges build Lightning and when the wallets build Lightning, and when there are other applications with Lightning, the utility leaps, the cost, the friction decreases.
According to Michael Saylor, Bitcoin adoption increases because of awareness and crisis, a specifically macroeconomic crisis that can be seen in the war between Russia and Ukraine.
Okay, so in a world where you have 100 million Bitcoin users using Bitcoin as their treasury asset, then you've got a certain demand. Now, if they decide they want to go all in and they want it to be 50 or 75 or 90% of their savings, adoption increases. When you go from 100 million to 500 million people using it, adoption increases. And adoption increases because of awareness. It's spreading over time. It increases because of crisis. For example, the Russian sanctions and the war in Ukraine, that drove adoption, macroeconomic crisis. COVID drove adoption. MicroStrategy never would have bought any Bitcoin if it were not for COVID and the lockdowns. So lockdowns drive adoption, pandemic drives adoption, war drives adoption, inflation drives adoption. A lot of the early Bitcoiners, they bought Bitcoin because of the hyperinflation in Argentina. Now, so if you didn't live in Argentina, you didn't get struck by that, but all of those macroeconomic crises drive adoption, but so there's good adoption. Technology is easy. Netflix is fun. I like watching it on my iPad, That's the good, easy, fun adoption.
There was a significant assertion in 1995 that internet use would shortly decline. This has to be one of the worst forecasts ever. Instead, innovation and digitalization have prepared the path for a futuristic world we never could have envisaged. Cryptocurrency, metaverse, and Web 3.0 are taking the globe by storm in digital spending, delivering safe information on the internet or giving an entirely virtual experience. Cryptocurrencies have evolved from digital novelty to trillion-dollar technology with the ability to destabilize the global financial system in a few years.
The world wants digital property, and digital property needs to be a commodity without an issuer. And the great shining example of creating a digital commodity is what Satoshi did. No ICO, no pre-mine, disappeared, never monetized it, not influencing it. If there's no issuer, then it starts to look similar to gold or wood or lumber or wheat or land. It's a commodity. That's very important. The world needs clear regulatory clarity with regard to what all the other tokens are. So if I want to create another digital commodity, I need a way to get it endorsed as a digital commodity. The other day, Gary Gensler went on CNBC and he said, the only token I'm going to speak to is Bitcoin. And I'm going to say Bitcoin is a commodity. I don't want to give an opinion on the other tokens.
All banks are institutions guaranteed by the Federal Deposit Insurance Corp, FDIC, a significant regulator in the sector. Therefore, several FDIC-insured banks collaborating to launch a stablecoin may appear to answer remaining concerns about this essential component of the cryptocurrency ecosystem. However, the technicalities, such as whether the agency can protect the stablecoin's owner's deposits, are still being worked out. This is why stablecoin is marketed as a safer choice for dealing on the blockchain. Bitcoin has not acquired momentum as a medium of trade in more politically stable places. Some detractors argue that this is proof that Bitcoin has failed. This is a naive conclusion. In reality, the characteristics that have hindered Bitcoin's development as a means of exchange have also helped it to become the finest currency in history. The assumption that Bitcoin and the blockchain must be utilized for day-to-day payments is based on a basic misunderstanding of Bitcoin. Let's hear what Saylor's take on this is.
And so the crypto industry has solved this problem. They're like, here's a fast way to create an equity-like token, and you can trade it 24/7, 365.
Whatever your personal view on cryptocurrency is, the key to dealing with dramatic market changes is to have a strategy in place so that you do not act in a panic. On a side note, some investors have recently promoted Bitcoin against gold as an alternative strategy to hedge against inflation. Do you think one is superior to the other? Comment down below. And don't forget to like and subscribe. This is The Daily Crypto. We'll see you in the next video.